In this class we want to talk about standard costing. Now you'll see from the bottom right hand side there are 80 slides in this class. That makes it quite a long class. So it's worthwhile having a rest from time to time and making sure that you make good notes as we go through the class. It's an important topic and it's worthwhile running the class over a couple of times as well. But make your own notes and have a break from time to time. Don't attempt to run the class from start to finish. It can get quite difficult in parts and well worth stopping and making your own notes. Having said that, let's make a start. Standard costing is the practice of substituting an expected cost for an actual cost in the accounting records, and then periodically recording variances showing the differences between the expected and actual costs. So in this case the accountants don't use the actual costs, they use a substituted cost. They use a cost that they think is more or less going to do the same work as the actual cost. In fact, of course, the cost that they may use, the substituted cost, may show variances from the actual costs in the business, and the accountants will have to deal with these variances to try and correct them, because the variances is really just another name for an error in the accounts, a difference between the actual and what the accounts are showing. But the accountants will use standard costing to substitute for expected costs in an actual account and in the accounting records. They will adjust the difference between the two, what the cost that they have used versus the actual cost. They will adjust for that. It's recorded as a variance and then continue to use it. Standard costing involves the creation of estimated, for example, standard costs for some or all activities within a company. So the accountant estimates what the costs are and uses that particular estimated cost, as opposed to using the actual costs. The main reason for using standard costs is the possibility that some businesses and production processes are too complex and too time consuming to collect actual costs. It may be far too difficult to collect the actual costs, so instead of doing that, the accountants will use estimated costs, standard costs, and then at the end of the accounting period will work out the actual costs of the business, look at the standard costs that were used, look at the variances, look at the differences, and correct their estimates. Make adjustments to their estimates to refine their estimates for the next accounting period. So in a sense it's a labour saving exercise. It's one enables the business to prepare its accounts in an efficient manner, a fast and efficient manner, and providing the variances are not too big, then there should be no problem in using standard costs. But periodically, because of the variances, accountants will make adjustments to their estimates which will bring them into line with the actual costs. So that's the main reason why standard costs are used. They're used as a close approximation to actual costs. Clearly the accountant will try and get the standard estimates, the standard costing estimates, as close to the real costs as possible. But there may be variances, as I said, and at the end of the accounting period the accountants will look at the variances and try to adjust their figures to correct for those variances. Since standard costs are usually slightly different from actual costs, the cost accountant periodically calculates the variances, the differences between the actual and the standard costs, and then makes appropriate corrections, as I said earlier. The variances may be due to many factors. For example, labour rate changes, the amount that's paid to workers may change, or changes in the cost of raw materials because of different market conditions for raw materials, or perhaps the impact of inflation, or whatever it is. So there may be several factors that lead to these variances. But whatever the factors are, the accountants will make their best estimate and use that as a standard cost, and then at the end of the accounting period will look for any variances between what they estimated and what the actual figures were, and correct for those differences. The cost accountant may also periodically change the standard costs to bring them into closer alignment with actual costs. So the cost accountant is constantly monitoring the accounts, and if during the accounting period they can see quite considerable variances arising for whatever reason, perhaps the cost of raw materials has increased dramatically because of some issue in some other country, or whatever it is. Now, if those variances are quite considerable, even though they're in the accounting period, the cost accountant may make adjustments to the accounts in that period, not just wait to the end. They may make the adjustments as they go through to try and minimize the amount of the variance that will be shown at the end of the accounting period. Now, the advantages of standard costing. Well, budgeting. A budget is always composed of standard costs, since it would be impossible to include in it the actual costs of an item on a day-to-day basis, or looking at how items can vary in price over the budgeting period. Items can vary in price for all sorts of reasons. One day the price may increase, the next day it may be reduced. Depends on the nature of the item we're talking about and how it's procured. But clearly the accountants don't want to enter into the budgets on a very frequent basis and start changing figures. If for no other good reason, it's going to upset the budget holder, who's going to find their figures changing perhaps almost on a weekly basis, or on a monthly basis, or on a daily basis, and may not be very happy about those constant changes. So as far as possible, the accountants try to estimate the costs, the standard costs, at the start of the budgeting period, and try to leave it with that to the end, and then make their adjustments at the end of the budgeting period. Inventory costing is another issue. It's easy to calculate the period end inventory balances, multiply the balance by the standard cost of each item. So that's an advantage of standard costs. They simply take the inventory balances. The storekeeper reports what items are in stock, and they multiply it by the standard cost of each item. So it's a very easy calculation to do. The result does not exactly match the actual cost of the inventory, but it's close. However, it may be necessary to update standard costs frequently if actual costs are continually changing, as I said earlier. So, although it's convenient, the accountant will have to apply common sense and realize that perhaps the figures are changing, the costs are changing, and therefore the costs of the stocks will have to be brought up to date. It is easiest to update costs from for the highest value components of inventory on a frequent basis, and leave lower valued items for occasional cost reviews. So in other words, the cost accountant will have to prioritize, will have to look at what items are high value and hence very important in terms of costing, and what items are relatively cheap or low priced, and they can wait until the end of the period to have their figures adjusted. But high value components, they may have to be changed on a very frequent basis, and they will perhaps be monitored by the cost accountants on a frequent basis, and their costings will be adjusted right across the accounting period. And the whole purpose of all of this adjustment, of course, is to try and ensure some high correspondence between the standard costs and the actual costs. In other words, to minimize the variances. Another advantage are the overhead issues. Overhead costs may be calculated by using standard costs. These may be adjusted periodically to keep them in line with actual costs. So the accountant can look at the overheads, make an estimate of what the overheads cost, and enter that into the accounts. The actual receipts for the overheads, the actual cost of the overheads, can then be worked out at the end of the accounting period and compared with the standard cost, the ones that were estimated. Any variances will then be corrected. And of course, the estimates for the next accounting period will be updated. So there's a process of learning here. As time goes by, the accountants know the trends in the costs and the way the costs change over a particular period, and are able to refine their estimates. So it's not just guesswork. This is it's an educated guess. It's calculated guess. It's based on as much information as the cost accountants can get about the particular item that's being costed, but also look at wider environmental impacts of changes and costings, and bring other knowledge to bear, so that the accountant, using his or her professionalism and experience, can make reasonable estimates of what the standard costs will be. I say reasonable, I mean as accurate as possible. And in the case we're dealing with here, that would apply to overheads. So they try to work out what the likely cost of the overheads will be, and then at the end of the period compare it to the actual and make adjustments accordingly. Another advantage of standard costing is the price formation exercise. When a company has standard and uniform products, then it may use standard cost to calculate the cost of customer requirements. Well, if the products are relatively standard and uniform, if it's making essentially the same items over and over, then the standard costs of the product could be perhaps very finely worked out in advance. The estimates for costs could be worked out very finely in advance, and that would mean that the marketing personnel or the senior management of the business will be able to set the price for the product, and they will be able to set it with a considerable degree of confidence. They may be slightly out, and at the end of the accounting period may have to make some adjustments. Of course, they don't want to change the price of the product to the customer on a frequent basis, because that may alienate the customers. Customers don't like to see the price of the product changing very rapidly or continuously. They like to have some sort of stability in terms of pricing. But the company will know what its actual costs are versus what it estimated at the end of the accounting period, and will be able to take some remedial measures to reduce or eliminate the variances. When this is completed, the company may add a margin to determine price. So once the standard cost is worked out, then the management may add on a markup, add a margin, in other words, to that, may decide that the standard cost is a certain amount, and then adds a certain percentage of that amount onto it, and that will represent its contribution to the overheads and the profitability of the business. So it does help in price formation. Although the process sounds simple, it must allow for the quantities required. these will partly determine the production and handling costs. So, although we say it's an advantage because of its simplicity, there are variations that can take place. For example, when companies receive large orders, they're able to set up production runs for long periods, and unit costs as a consequence may fall, so that the standard costs are no longer accurate. It may also be the case that the companies receive small orders, but they want to complete the small orders because they will enable them to get a foothold in a particular market, let's say. So if that's the case, the small orders may be expensive to produce and therefore be above the standard cost estimates. So there are technical innovations and changes that occur within the organization, and these can occur in relatively short periods of time, which can affect the standard costs. And indeed, just the ones I mentioned a moment ago in terms of production runs, large production runs, small production runs, they can also influence the costs of the costs, and thereby lead to variances with the estimated costs. Standard costing provides a benchmark against which management can compare actual performance. So once the accountants have worked out what the standard costs are, in a sense that becomes the benchmark. Now any variance when calculated needs to be investigated. Why is there a variance? How can the company account for the variance? What caused it? Perhaps it was caused by some inefficiency within the company, which needs to be investigated. Or it could be caused by market changes, which are external to the business. But again, it's important to simply note what happened, what caused it. So some may require intervention and some sort of remedial work to try and get it fixed, to try and bring the standard cost and the actual cost into alignment. But some can't be dealt with because they're outside of the company. The market price of raw materials, the company may have very little to do with that. So therefore it can't change anything. It has to accept that the variance was caused by that and just simply change its standard costs in the next accounting period to allow for those changes in the cost of raw materials. Now, problems with standard costing. Well, cost plus contracts is one problem. Some contracts are based on costs incurred plus a markup for profit. This is known as a cost plus contract. In this case, actual costs must be used since these form the basis of the contract. And this is not standard costing. This is this would be looking at the cost of the product. It may be that it is standard costing in the sense that the accountants will estimate the costs beforehand, but the final figure, the final cost of the product will have to be inserted into the accounts, and then the markup is added to that. There are problems with cost plus contracts. They can lead to inefficiencies. For example, companies who tender to the government for contracts may use cost plus procedures, particularly if the government is desperate to get some work done. Well, this means that the company has an incentive to inflate its costs because its profits will be based on its costs. And the more costs it's got, the more profits, the more the markup will be, hence more profits it will make. So cost plus contracts can be inappropriate under certain circumstances. Standard costing, well, it drives inappropriate activities. Now, what we mean by that is that in an effort to reduce variances, management may take incorrect actions to create variable variances. So sometimes the accountants don't want to report wide variances because it looks like their estimates were wrong from the start, or perhaps they didn't work out their standard costs properly at the start. So the management accountants may take decisions which will correct for the variances throughout the accounting period, and this will reduce the variances. For example, raw materials may be bought in larger quantities in order to improve the purchase price variance. However, this increases investment in inventory. So it's an inappropriate decision. On the one hand, it brings down the variances. It brings actual costs more in line with the estimated costs, with the standard costs. But on the other hand, it means the company now has a lot more inventory to finance. So efforts to keep standard costs in line with actual costs, in other words, to reduce the variances, those efforts could lead to what this calls inappropriate activities, wrong activities. They're trying to correct the problem of variance by increasing inventories. There's actually no need to do this other than the requirement on the accountant side to minimize criticism of their estimates. That would be far preferable to than the company holding large inventories to try and cover up faulty estimates. Similarly, management may schedule longer production runs to improve labour efficiency variances, again adding to inventories. So depending on what the standard cost relates to, if it's going to be a lot different to the actual costs, then efforts on the part of management to try and correct for these variances may be counterproductive. They may be bad for the company. Problems with standard costing. Well, a fast-paced environment. A standard costing system assumes that costs do not change much in the short run. This means that standard costs can be relied upon for a number of months or longer before they need to be updated. So ideally, standard costing systems assume that costs do not change much in the short run. So standard costing systems are most appropriate when there is that sort of stability in the system. The accountants can work out what the likely costs are going to be and use those in the expectation that over the period of the accounting cycle until the actual costs are discovered at the end, there's not going to be much variance or difference in the costs. And that's the expectation. However, in an environment where product lives are short, or continuous improvement is driving down costs, a standard cost may become out of date within a short period of time. So in more dynamic environments, standard costing is much more problematic because there are so many things happening. For example, changes in the price of raw materials, changes in technology, improvements in productivity within the organization. All of these will have an impact on standard costs, on standard cost estimates, and will tend to knock out the standard costs and introduce wide variances. But that's caused by understandable factors, increasing productivity, for example, and desirable factors. So it means standard costing simply is not appropriate under those conditions. Slow feedback. Well, variance calculations which are based on the standard costing system need to be completed in each reporting period. It's important that variances are calculated in each accounting period. If they're not, if they're just left and the same standard costs are used for a long period, then it may become widely out of date. So it's important that the variances are updated on a regular basis, and that standard costs are updated on a regular basis to reduce the variances. In other words, at the end of the accounting period, all the various standard costs should really be scrutinized to see what the variances are and what corrective action needs to be taken in terms of adjusting those standard costs. Reports from the production department may be slow because of pressure of work, and therefore the calculation of variances may be slowed also. So it may be difficult to review all of the standard costs used, but even though it's difficult, every effort should be made to ensure that the standard costs are as accurate as possible. Even though there may be pressure in other parts of the organization for other information or other work to be completed before this, nonetheless, standard costs need to be realigned on a regular basis. Unit level information. Well, the variance calculations may be aggregated over the appropriate departments and is therefore not sensitive to individual processes or components. So sometimes, for not just for convenience but for efficiency, instead of having a standard cost for every particular item, the accountant may try to work out what the standard cost of a particular process is. And the particular process may involve the use of many items, including labour, machinery, different types of raw materials and components. So it tries to work out what the standard cost of that whole process is. Now that means it's only looking at one standard cost as opposed to perhaps looking at many standard costs had it taken each individual component into account. But of course, the more aggregated it is, the less information that's available. And it may be that a particular standard cost has moved because just one of the items that is included in that aggregate has varied considerably. Perhaps the rest have not changed considerably. So there's information lost. Whenever we aggregate, we lose information, we lose sensitivity. We don't know what's happening inside the aggregate. Now, standard cost variances. Well, a variance is the difference between the actual cost incurred and the standard cost against which it is measured. That's what a variance is. It's the difference between the actual cost and the estimated standard cost. A variance can also be used to measure the difference between actual and expected sales. That would also measure, be given to us by a variance, a difference in other words. Therefore, the variance analysis can be used to review the performance of both revenue and expenses. We can use this idea of variance, of difference, to look at both revenues and expenses. Now, standard cost variances. Well, there are two basic types of variances from a standard. The first one is called rate variance, and the second is volume variance. Now, rate variance, well, a rate variance is also known as a price variance. This is the difference between the actual price paid and its expected price multiplied by the actual quantity purchased. So it's looking at the actual versus the expected price times the actual quantity purchased, and that's the rate variance. The rate variance designation is most commonly applied to the labour rate variance, the actual cost of direct labour compared to its standard costs. And that would give a rate variance, a difference between the two. Volume variance, well, a volume variance is the difference between the actual quantity sold or consumed and the budgeted amount multiplied by the standard price or cost per unit. So that's the volume variance. We take a standard price or cost per unit and we multiply the difference between the actual quantity sold and the budgeted amount. Now the terms used, well, sales volume variance, material yield variance, this relates to the use of direct materials. Direct labour, this is called the labour variance or the labour efficiency variance. And overhead is called the overhead efficiency variance. So we can work out variances for different aspects of costs, different types of costs within the business. As long as we can work out what the actual cost is at the end of the accounting period, we can make an estimate of what the costs are going to be throughout that period, the standard costs, and of course the difference between the two is just our variance. Now variances are based on either changes in costs for an expected amount or changes in quantity from the expected cost. So we have changes in cost for an expected amount or changes in quantity for an expected cost. Depends on which way we want to do it. The most common variances reported are related to direct materials, direct labour and overheads. These are the most common variances that accountants seem to focus in on. It's not always considered practical or even necessary to calculate and report on variances, unless the resulting information can be used by management to improve the operations or lower costs of a business. So sometimes the variances are not a big issue. At the end of the accounting period, if the variances are quite small and quite insignificant, the accountant simply makes adjustments and life goes on. If, of course, the variances are significant and represent a considerable amount of the company's resource, and there's a considerable discrepancy between what they expected and what actually happened, then this may require managerial intervention and inquiry. Now, setting a standard cost. Well, a standard cost may be determined by calculating the average of the most recent actual costs for, let's say, the past few months. In other words, the accountant collects some data on the costs of a particular product or a particular activity. And it collects the costs for different time periods and takes an average, looks at the trend and makes an estimate. Now, factors that may influence the standard costs calculated. Well, the equipment age. If a machine is nearing the end of its productive life, it may produce a higher proportion of scrap than was previously the case. So in making estimates for standard costs, the accountant must factor in that the capital is no longer in pristine condition and that earlier figures will be different to later figures because machines are wearing out, tools are wearing out, and the costs are likely to rise as they move into the future. So equipment age needs to be borne in mind when setting standard costs. Also, equipment setup speeds. If it takes a longer time to set up equipment for a production run, the cost of the setup should be spread over the units in the production run. So the accountant must be aware of how long does it take to set up for a particular task, and look into what determines the setup costs. Then try to spread over the production run the setup costs. So care has to be taken in working out standard costs for these reasons in particular. Labour efficiency also changes. If the productive processes changes, such as the installation of new automated equipment, then this impacts on the amount of labour required to manufacture a product. And that again will influence the estimates of the standard costs. Perhaps fewer workers are required. However, perhaps the workers will have higher skill levels because they're able to use more sophisticated machinery. Labour rate changes. Employees may receive pay rises, either through scheduled rises or as mandated by a labour union contract, and these may be incorporated into the new standard. The accountant must be aware of the fact that, let's say, that labour costs are about to change, so that the standard cost will have to be adjusted from one period to the next to cope with this change in labour cost, which will be part of the costing of the product. There's a learning curve. As production staff creates an increasing volume of product, it becomes more efficient at doing so. Thus the standard labour cost should decrease as production volumes increase. It's likely to be the case that over a period of time the workers will become more adept at producing the product, more skilled at producing the product, more efficient, and therefore will produce more of it in a particular time period. Labour costs as a consequence would fall. Again, the accountant must be aware of this when setting standard costs. And purchasing terms will be our last topic. The purchasing department may be able to significantly alter the price of a purchased component by switching suppliers or altering contract terms or by buying in different quantities. Again, the accountant must be kept informed and understand what's happening in terms of costings of raw materials or components or semi-finished goods that are bought in, so that they can enter those costings into their standard costings for the product that the company is making. So all of these factors must be borne in mind by the accountant when setting standard costs. So that concludes this talk on standard costing, an important topic. Please rerun the video several times and make your own notes, and do some research into the area as well from PDFs and online sources. In the meantime, that's all we're going to do here, so thank you for watching.